Hello everyone, welcome to Run Coaching Institute. Our today's topic will be continuation from previous topic, monetary policy and RBI regulation part 2. Before I go into the topic, I would like you all to like, share and subscribe or follow for more such useful learning videos and contents. So we'll move on to the topic. Today's topic, previous video we had learnt about CRR and that was cash reserve ratio. This video will start with SLR, statutory liquidity ratio. SLR, all banks have to maintain a portion of their total deposits with RBI either as cash or gold or approved securities. This is as per section 24 of the Banking Regulation Act 1949. There is no floor rate, but the ceiling is 40%. To be maintained in cash, gold and approved securities, to hold a percentage of NDTL in the above terms as prescribed from time to time. Policy rate. In policy rate, we have repo rate, reverse repo rate and MSF, marginal standing facility. In repo rate, when banks sell security, banks promise to buy back the same security from RBI at a predetermined date with an interest at the rate of repo. It is actually a repurchase agreement. When RBI reduces the repo rate, the bank can borrow more at a lower cost. Minimum amount of loan is 5 crores. Repo rate is actually a short-term lending, that is, they have to repay it back by 1 to 90 days. Reverse repo rate. In case RBI borrows money from banks and the interest paid by RBI to such borrowings from the bank is known as reverse repo rate. It is the opposite of repo rate. An increase in this rate can cause the bank to transfer more funds to RBI due to attractive interest rates. Hence, RBI uses this way to draw out excess money from the bank. MSF, Marginal Standing Facility. Marginal Standing Facility is actually it is a facility provided by the central bank, that is the Reserve Bank of India in India, that allows commercial banks to borrow money overnight when they face a shortage of funds. The key points is bank can borrow from central bank against approved government securities. It acts as an emergency funding window. The MSF rate is generally higher than the repo rate, making it a last resort borrowing option. This helps maintain stability in the banking system and manage short-term liquidity shortages. Next, we move on to bank rate. Bank rate is the interest rate at which the central bank lends money to domestic banks. Such loans are given out either by direct lending or by rediscounting, buying back the bills of commercial bank and treasury bills. Bank rate is also known as discount rate. The interest rate which the RBI charges for its long-term lending is known as bank rate. Bank rate is a long-term lending up to 365 days. Normally, banks, financial institutions use this facility. This has got direct bearing on the long-term lending activity of the financial system. Open Marketing Operations, OMO. Open market operations means RBI is purchasing government securities to infuse liquidity. RBI is selling government securities to suck liquidity from the system. Quantitative credit controls. Under quantitative credit controls, you have the policy rates, that is bank rate, repo rate and reverse repo rate, reserve ratios, CRR and SLR, and open market operations. Qualitative credit controls, margin requirements, rationing of credit, regulation of consumer credit, moral suasions, direct action, and RBI guidelines. For more such information, kindly like, share, follow, and please repost it for our fellow members. Thank you.